Moscow, February 2023. A currency trader sits in front of three monitors. On the left screen, the ruble-dollar exchange rate. It reads 75. On the right screen, the same rate from 12 months earlier. It reads 75. In between, a Bloomberg terminal showing hundreds of lines of code, regulatory updates, and a single highlighted phrase, mandatory conversion requirement extended. The trader leans back. To an outsider, this looks like victory. The ruble has held. It survived the largest sanctions package in modern history. It weathered the exodus of foreign capital, the freezing of central bank reserves, the departure of Western brands. The exchange rate barely moved. But the trader knows something the headline doesn't say. He's not trading in a market. He's operating inside what he calls the aquarium. In a real ocean, a fish swims where currents take it. In an aquarium, the fish swims in circles. The water looks clear. The temperature is controlled. But the glass walls are invisible until you try to leave. This is the story of a currency that didn't collapse because it was never allowed to be tested. When you see a stable exchange rate, your brain makes an automatic assumption. Stability equals strength. A currency that holds its value must be backed by a strong economy, sound fundamentals, investor confidence. This is the myth we've been trained to believe. It's the logic of the free-floating era. If the British pound strengthens, it's because investors want to hold pounds. If the Turkish lira collapses, it's because investors are fleeing. Price discovery tells the truth. But what happens when price discovery is turned off? The comfortable narrative after 2022 went like this. Russia's economy proved more resilient than expected. Energy revenues cushioned the blow. Import substitution worked. The doomsday predictions were wrong. The ruble's stability is proof. This narrative is everywhere. You see it in headlines. You hear it in analysis. It's comforting because it fits the old rules. Strong currency, strong country. But this story has a fatal flaw. It assumes the ruble is trading in a market. It's not. The ruble isn't strong, it's fenced in. Let's go back to March 2022. The ruble crashes to 120 per dollar. Panic, capital flight. The central bank's foreign reserves, half of them are frozen in Western banks. This should be the beginning of a currency death spiral. But within weeks, the ruble not only stabilizes, it strengthens. By June, it's at 55, stronger than before the war. Western analysts are baffled. How? The answer is a cascade of controls, each one creating a new wall in the aquarium. Control 1. Mandatory conversion. Russian exporters, the giant energy companies shipping oil and gas, are required to convert 80% of their foreign currency revenues into rubles. Immediately. No exceptions. Think about what this does. Every tanker of oil sold for dollars must be converted into rubles. Gazprom, Rosneft, Lukoil, they become forced buyers of their own currency. Artificial demand. The ruble strengthens not because investors want it, but because the law requires it. Control 2. Capital restrictions. Russians who want to buy foreign currency face limits. You can't withdraw more than $10,000 in cash. You can't transfer money abroad without approval. If you're a business, forget it. The doors are closed. Control 3. Interest rate manipulation. The central bank briefly spikes rates to 20%, then gradually lowers them. This isn't market signaling. It's crisis management. The goal isn't to attract capital. It's to prevent capital from finding exits. The result, the ruble stops behaving like a currency in a market. It starts behaving like a number in a spreadsheet. But here's the cost that nobody talks about. If you're a Russian importer trying to buy euros to pay for machinery, good luck. If you're a multinational company trying to repatriate profits, frozen. If you're a Russian citizen who wants to protect savings by holding dollars, illegal. The exchange rate is stable, but the exchange itself has been disabled. This is what I call the aquarium effect. The currency looks healthy because it's swimming in controlled water, but the moment you remove the glass, the system collapses. To understand what's really happening, you need to stop thinking about exchange rates and start thinking about flows. A currency's value in a free market is determined by flows. Money flows in, currency strengthens. Money flows out, currency weakens. Simple. But Russia after 2022 doesn't have flows. It has curated circulation. Here's how curated circulation works. Imagine a water fountain in a closed loop. Water goes up, water comes down, water is pumped back up. The water never leaves the fountain. You can measure the flow rate, but it's not connected to an ocean. It's not subject to tides. It's a closed system. Russia's currency system is now a closed loop. Foreign currency comes in through energy exports. That currency is immediately converted to rubles. Forced demand. Those rubles circulate domestically, but they can't easily leave. The loop is closed. This creates what looks like stability. The ruble exchange rate stays in a narrow band, but it's not stability in the economic sense. It's containment. The real test of a currency isn't what it trades at, it's what you can do with it. And here's the trap. The more stable the ruble looks on paper, the more invisible the costs become. Cost 1. Inflation. When you cut off imports and force domestic substitution, prices rise. Russian inflation hit 11.9% in 2022 and remained elevated through 2023. The ruble might be stable against the dollar, but it's losing purchasing power at home.
A stable exchange rate with high inflation is a magic trick. The number stays the same, but the value disappears. Cost 2. Economic isolation. Russian businesses can't access international capital. They can't hedge currency risk. They can't diversify. The economy becomes brittle. Innovation suffers. Efficiency drops. Cost 3. The pressure valve problem. In a free market, a weak currency is a pressure valve. It signals problems, yes, but it also makes exports cheaper and gradually rebalances the economy. When you disable that valve, pressure builds, and when pressure builds with no release, systems crack in unexpected ways. This is the paradox of curated stability. It solves the immediate crisis, but it creates a long-term dependency. The longer the controls stay in place, the harder they are to remove. Because the moment you open the aquarium, everyone swims for the exit. Russia isn't alone in discovering this playbook. Argentina did it. Venezuela did it. Turkey flirted with it. China has been running a sophisticated version for decades. The pattern is always the same. When a currency comes under pressure, you have two choices. Let it fall, painful but market clearing, or build the aquarium, stable but trapped. And here's what's changed in the 21st century. The aquarium is getting easier to build. Why? Technology. In 1990, tracking capital flows was hard. Enforcing conversion requirements was harder. Now, digital banking means every transaction is visible. Every wire transfer can be flagged. Every currency exchange can be monitored in real time. The old economics textbook said capital controls don't work because people find ways around them. That was true in the era of briefcases full of cash. It's less true in the era of algorithmic surveillance. This is the new rule. Stability is now a design choice, not a market outcome. If you're willing to pay the costs, inflation, isolation, inefficiency, you can keep your currency inside a narrow band almost indefinitely. The question isn't whether you can do it. The question is whether you should. And this is where the ruble story becomes a warning for every other currency facing pressure. Because once you build the aquarium, getting out is harder than getting in. Turkey discovered this. Argentina discovered this. Every time you try to remove controls, capital tries to flee. So you leave the controls in place, and the longer they stay, the more your economy adapts to the distortion. Businesses make plans assuming the controls exist. Households make decisions assuming borders are closed. The aquarium becomes the new normal. The ruble hasn't collapsed, but it hasn't won either. It's stable in the same way a fish in a tank is stable, as long as the pump keeps running. So is the ruble strong? If you define strength as the number on the screen, then yes, the exchange rate is stable. The central bank can point to the chart and say we held the line. But if you define strength as what the currency can actually do, the answer is different. A strong currency is one people want to hold voluntarily, one that can be freely exchanged, one that holds value not because of walls but because of trust. The ruble today is none of these things, and this matters far beyond Russia, because the same tools that stabilize the ruble, forced conversion, capital restrictions, curated circulation, are now in the toolkit of every emerging market central bank watching their currency weaken. The next time you see a headline celebrating a currency's stability, ask a different question, not what's the exchange rate, but what are the walls? Because in the age of capital controls, stability is cheap, freedom is expensive, and the invisible glass of the aquarium only becomes visible when you try to swim through it. The ruble hasn't collapsed, but it's not swimming in an ocean, it's circling in controlled water, and the pumps are still running. For now,